Let's bring in Jack Ablin. He's founding partner and CIO of Cresset Capital. Jack, thank you very much for being here with us today. Rick Santelli kind of just gave us the lowdown there on fixed income, but I guess I'll get your reaction after we got that hawkish statement and press conference from the Fed and from Jerome Powell. Has anything changed about your approach for, say, the next several months in your management of a portfolio?
No, I think nothing's really changed on our front. Our base case scenario is probably close to consensus. We do expect slowing growth, slowing inflation. The economy has actually been a little more resilient as we started the year, certainly labor market and the like. And that's giving the Fed a lot more elbow room. They don't necessarily have to tighten as quickly as perhaps the Fed funds futures would suggest. And I think that's probably putting a little pressure on that 10-year.
So I have a lot of focus on tech today, of course, as we're waiting to hear from some big reporters after the bell. And then we talked about the Magnificent Seven as well. Clearly have come a very long way. So is valuation the reason that you potentially see some underperformance for that group? Is it somebody else's turn, frankly, to pick up that performance? What's your theory about the Magnificent Seven and tech more broadly going forward?
Yeah, so absolutely. I think there are really two factors at play here, Courtney. One is, look, the Magnificent Seven did great last year, right? Collectively up over 100%. But keep in mind, in 2022, they were down nearly 50%. Now, over the last week, since Tesla's pretty lackluster earnings announcement and Alphabet, we're seeing the Mag 7 down around 3% over that time between last week and this. And in fact, two of the Mag 7 are in negative territory, Tesla and Apple, year to date. Where we see an issue is we're setting up now with the relative valuation of tech in particular, trading at a 53% premium to the rest of the market on a forward PE basis. When you look 1 year out, the chance that tech will continue to outperform when it starts at this high of a relative valuation premium is tough. In fact, the best result we've ever seen is probably a plus 5% outperformance, and there's certainly a lot room to underperform the market. Now, it doesn't necessarily mean that this sector will drop. It just means that with lower yields, with a broadening of the economy, making financing costs a little bit easier, it creates a tailwind for just about everybody else.
You mentioned among the other beneficiaries of falling rates, small caps, select ones, and financials. And yet three of the stocks you mentioned are REITs. Why REITs?
Yeah, so REITs certainly have been punished. Perhaps, everyone is looking at the commercial real estate and how owners are somewhat in denial. The general partners aren't moving their marks in tandem with where we think the market is. The fact is, REITs have already gotten hammered. In fact, we're looking at implied cap rates in double-digit territory in a lot of these categories. The good news here is these names are high quality because we have a very high quality screen, but they also have high dividends and high dividend growth. So Realty Income, 5.6% dividend yield with a 3% annual dividend growth. Essex Property, 3.9% dividend yield with a 4.4% annualized dividend growth. And Federal Realty, 4.3% dividend yield with a 1.4% annualized dividend growth. So constant growth. I think it's probably in an environment where we think overnight rates will come down. We don't know if it early as March, but financing will start to become a little bit easier. That will help financials, but it should also help the real estate companies in particular.
Excellent. Jack Ablin, we thank you. Appreciate it.